and welcome to the final VFS International webinar of 2022. This webinar follows on from a series of presentations hosted by Mr. Manish Sharma of Continental Life. What we find is that successful people like to create assets for not only their own benefit, but for future generations. The issue which they have is if they need to access these assets, they are often illiquid, such as property. Manish will go through an alternative which will suit a lot of people and benefit them not just for now, but also in the future. Enjoy and thank you very much.
Hi, good morning everyone. Thank you Anthony for the warm introduction. It's a lovely morning here. I'm here from Mauritius and today I will going to talk to you about something interesting, something related to legacy or succession. So it might be a good webinar today for all of you to know something new about a new product. So to start with, this is about me. Anthony has spoken to you, but just to give you a background, in last 21 years, I'm working with banking and financial institutions, and I expertise into wealth planning, legacy, succession, wealth management, and these are my areas of expertise. So today I'm going to talk to you about very interesting product, which is Venus 2, which is kind of a legacy, liquid legacy plan, which can help you to create wealth, long-term sustainability, and which you can even pass on to generations, which generally everyone do with their assets. So before going into detail about the product, I would like to give you some insight about the provider. So the provider for this product is none other than Sun Life from their Hong Kong entity. Now Sun Life itself is a 154-year-old group based out of Canada, but this product is offered through their Hong Kong entity, which itself in Hong Kong is 129 years old, AA rated, paid almost 30,000 plus claims in 2020, has partnership with more than 450 brokers throughout the globe. It's a very well trustworthy brand to deal with. Now, something about high net worth, because this product is for a niche market. It's a high net worth individual or ultra high net worth individual product, and Sun Life has 20 plus years of experience in underwriting for this niche market. Okay, in 2020, they earned many awards, which is 11th Benchmark Wealth Management Award, Insurance Excellence Award, Banking and Finance Award, or 5th Asia's Trusted Life Agent and Advisors Award. So they are a well-established brand throughout the globe. And in Hong Kong itself, they have spent more than 129 years. So they understand the market and the products for the HNI and Ultra HNI network. Now, what is Venus 2? It's a participating insurance plan which offers long-term wealth growth with just a single premium payment option. Now, before going detail into the product, let's understand what is legacy, what is assets. So if we talk about legacy, it can be inherited legacy, like second generation business, third generation business, we call it HNI. People might have inherited business from their previous generation, and then they are continuing and growing that business. They have inherited assets from their family, maybe a family property, and then they build it, and they can multiply those assets and transfer to their next generation. That is called inheritance of legacy. It could be a self-made person, the first generation person who has built everything on his own or her own and then transferring to the next generation, or it could be first generation, second generation, third generation legacy, which they have inherited from their previous families, and then they are growing, and then they pass on that legacy to the next generation after a certain period. But if you look at the statistics, most of the time you will find the legacy which is inherited is illiquid, either in form of business, which they have got from their fathers or forefathers, which they are growing now, or they got some properties or something like paintings or horses or cars or anything. Most of the time it is illiquid. Now the challenge with the illiquid legacy is that if you need financial support, if you need cash, to be specific, you can't sell part of that business. That okay, I'm selling maybe 10% of my property. You can't sell that, or 10% of my business. Maybe you don't want to liquidate that. So the challenge becomes is, if you need financial support from your asset, it is difficult to sell your illiquid assets. So looking at that, Venus 2 is one of the important product because it provides liquid asset, liquid legacy. How? Because it's a long-term product which can be passed on from generations to generations. So basic key features about this product is stable long-term growth. It provides you stable long-term growth, wealth accumulation over a longer period. So to be specific, 120 years total. It can be passed on generations to generations. So as you said, as I clearly said, pass your wealth to future generations, which means basically today you are taking this policy, you can pass on to your next generations, they can enjoy it. Later it can be passed on to the third generation, they can enjoy it. And withdrawal options to meet your financial needs, which I said, for your illiquid assets, it becomes very difficult to sell part of your business or part of your property. But here with this product, you can partially surrender to use the money for your needs and later on pass on the rest of the benefit to the next generation. It will keep on growing. They can use it and they can further pass it on to their next generation. So to be specific, this product can be passed on to minimum 3 generations easily. So I will come on the product, how it grows and everything in future slides. Further slides actually. So because when we talk about the future, this is future, so every time it comes into our mind that how we can get benefit in future for these plans. So now key feature, again talking about this, flexible death benefit settlement option for your family if anything happens. So you can take this plan, you have taken this plan, if something happens to you, your family gets the money. But then there is an option here also where you can include 2 people as a insured. So you don't want this policy to be surrendered because you want to use it as a legacy to pass on. There can be 2 insured at a time. So if something happens to one person, the other person continues the product and can add further person in the policy. I will talk about that. Fulfill your promise to the next generation. So this plan gives you an option of liquidity where you can pass on the liquidity to next generation. So not in form of illiquid assets like property, which is already there, which is already you are diversifying through business, through property, through other illiquid assets. This one gives you liquidity which you can pass on to the next generation. Now, easy application, there is nothing much. No medical examination, no health questions, nothing is required. You are resident of any country. Yes, specific, not to the high risk countries or sanctioned countries. Otherwise, you are residing anywhere. It can be offered. If you even have a medical conditions, it can still be offered. So now, what is proposition and introduction? Now, understand there is a huge demand nowadays in the HNI and ultra HNI market where they are looking for a liquid product which can provide them a stable guarantees and all. So this product was first launched as a pilot run in 2020 from Sun Life, and it was only for a year. And it has received so much huge response by clients that they wanted a similar kind of a product. So then later in 2021, Sun Life came up with a upgraded version of Venus, which is Venus 2, for a longer period up to 120 years, where people have stable guarantees and a decent growth because it's a participating product from Sun Life. So I will talk about how the investment works and everything in this. Now, This offers a cash value guarantee. Guarantee means capital guarantee. So whatever you are investing in this product, there is a capital guarantee. Initial slightly lower, and in later years, 100% capital guarantee, along with the revisionary and terminal bonuses, which is added because it's a participating product. So there's a huge investment returns on the investment side of the product. Now, who is the target client for this? So that's important to understand. This is for the people, those who are looking for wealth accumulation. They want to grow their wealth in terms of liquid. So this is meant for them, people for looking for the education planning, because this plan can fulfill the needs at different stages of life. You have taken this plan today, at later there's a newborn baby, at later down 20, 25 years or 30 years, you're looking something for the education for your child or for starting a business for them. You can partially withdraw the liquid amount from this and use for that purpose. Or people looking for estate planning, they want to pass on the legacy to next generation. They can use this plan to pass on the legacy for their next generation, and they can further use it and pass on to their third generation. So you can enjoy and then pass on. Your next generation can enjoy, they can pass on. Even the third generation can enjoy if they want to pass on. If the enough period is left in the policy, then yes, they can pass on to the fourth generation also, or the policy will come to an end when it completes 120 years in total. Now, core features are day one capital guarantee of 88% of the amount you are contributing in this plan. So which means from day one, 88% of your capital is guaranteed, and from the third year onwards, there is a terminal bonus which is added. It is 8th year earlier, now they have changed it to third year, and from 8th year onwards, revisionary bonus will be added. So you start getting bonuses from third and the 8th year onwards, and your capital is guaranteed from day one, 88%. Now, it's one of kind of a savings plan which runs maximum for 120 years. Which is not available in the market, which can be passed on. Okay, there are plans which can run up to a longer term if you survive, but survival up to age 120 is very difficult. But this plan, today you are insured, you can pass on to your next generation, they can enjoy, they become the insured. So you can change the policy owner at any stage and any number of times. So passing your wealth to future generation with unlimited change of insured when needed. As I said, today you are the owner of policy. Maybe down the line when you reach at age 70 or 80, if you see, or even earlier, you say, okay, I want to transfer it to my son. You can change the insured. You can exit the policy, your son becomes the owner, or your daughter becomes the owner, or your wife becomes the owner. You can change the insured, they can carry on further and they can further transfer it. So change of cover option helps client to transfer of wealth in the event of unexpected death of one of the insured. So at a time, you can have two insureds in a policy. So why that is important? Because if you keep only one insured and the person passes away, the policy will come to an end, and whatever the growth value is there, that will be paid to the beneficiary. But if you have two insureds, so one passes away, the policy continues, and the second one continues the policy and can add another one into the policy to further grow the same. If both the insureds dies together, which is very unfortunate and happens rarely, so in that case, yes, it will come to an end. So maximum two insured can remain in the policy at a time. So for example, designate a contingent policy owner for a plan B when unfortunate happens. So if one person is not there, there's another designated insured person, second person, who can continue the policy and can add further the third person in the policy. Now, as I said, worry-free application process without any medical underwriting. So there is no medical underwriting required, no medical questions. Even someone is suffering with the critical illness and all, still can take this policy. Flexible settlement option for death benefit. So if you want to continue policy with one insured, yes, death benefit will be paid, which is equal to the amount you have invested in the policy plus the revisionary and terminal bonus growth that will be paid in case of death. But when there are two insured, it will continue. Same premium rate for all insured. So this is another interesting thing, which generally doesn't happen with other insurance plans. With the age increases, the premium increases. But here it will remain same for every age. So we can even offer this plan up to age 80 of the client, from 0 to 80 years. So even whatever the rate is there for 0 years remains the same for 80-year-old person also. Now, how does this work? So whatever premium you have paid at the start of the policy, single premium, so guaranteed cash value is 88% upon inception. So from day one, there is a guaranteed cash value of 88%. Third year onwards, there will be terminal bonus added, and 8th year onwards, there will be revisionary bonus added, which I will going to talk to you how the revisionary bonus comes or terminal bonus comes in the investment part of this presentation. And from the year 20th, this 88% becomes 100%. So that means if your policy completes 20 years, your capital guaranteed cash value is 100% plus the bonuses. So no worry, even if there is a epidemic, there's pandemic, there's war situation or anything, your capital is secured. No risk at all. Then now, case study regarding the withdrawal accumulated revisionary bonus. So let's take an example. There's a Mrs. A who is 30 years old and newly wedded, preparing to welcome a new baby in the family. They are loving parents. So they want to start something as a wealth to accumulate. So she decides to invest $200,000 in this plan. Now, if you see, she's 30 years old. 23 years down the line, when she will be 53, her $200,000 have become $624,000 with a revisionary and terminal bonus growth, which is 312% growth on her investment. Further 10 years down the line, when she is 63, the value of her investment has become $1,088,000. And when she reaches at age 80, the growth is 1599%, which is $3.197 million. So the investment remains the same, $200,000. This has grown. Now, at any stage during her life, she wants to withdraw partial, she can withdraw, rest will keep on growing. If she withdraws full, the policy will come to an end. Or at any stage, she can decide at age 63, I want to exit out of this policy and I want to change the insured to my son or my daughter. She can even do that. So there are all possibilities in this plan. It's totally flexible. Now, change of insured options. Let me talk little detail about that. This is extension of benefit change of insured option when needed. So it enables client to pass on their wealth to next generation without any extra cost. So there is no extra cost that we will underwrite the new insured with their age or with medical condition, then there will be loading on nothing. There is no extra cost. You have to just give an application to change the insured, underwriting will happen and the policy gets transferred to the next person. Now this can be done after first anniversary of the policy and can be done any number of times during 120 years of the policy. You can change, you can add, you can remove, you can further add, you can change the insured any number of times during the policy, which is again a very good benefit about this plan. Maybe today you have transferred it to your son, maybe tomorrow the son wants to transfer it to their son or their daughter, or you want to keep yourself as an first insured, you can add second insured, your son, and you want to remove him and you can bring your daughter or your wife. You can do anything with your policy till the time you have control of the policy. Another way is you exit out of the policy and you transfer the wealth to your son. Same like property. You inherited a property from your family. Now you are the owner of the property. You can take a decision. You want to sell it. You want to further build it. You want to transfer it to the next generation. Once you transfer, they get the control of the policy. So same thing is with this. That's why we call it liquid asset. You can change the control options of the policy. Now, let me give you an example on this policy. Now, at policy issuance, so let's take an example. It's how you change an insured in this policy. Now, at policy issuance in year 21, the benefit term is calculated on the age of Mr. P, which is he is 35 years old. So 120 minus 35, maximum if he wants to keep the policy in his name, it will run maximum for 85 years. But after 5 years, he decides to change the insured to his son. As his son is younger, the benefit term will be extended according to the age of the son. So maximum 120 years. So new benefit term can be calculated as below. Number of years in force is 5 years. Number of years until Mr. P's son reaches 120 is 15 years. So that is, the policy can run for total 120 years, because 5 years the father enjoyed, 115 years son will enjoy. So total 120 years a policy can run. So that's how it can keep on growing. So you can extend the benefit of the policy based on number of years a policy run. The longer the policy runs, the higher the growth is there, higher the benefit is there. Now, let me give you example, the change of covered option. So which is rare in the market. Very rarely you will find the policies which can give you this kind of a benefit, that you can change the insured of the policy. So first, single life of policy, you can change it to joint life. You are there, you can add your spouse, or your spouse is there, she can add you, or you can even add your son or your daughter or your parents as a second insured in the policy. So what is the benefit? If something happens to one person, the policy still continues, doesn't come to an end. Now, this is the example for a single life policy. If one person is there as an insured, if something happens at the death, the death benefit is payable, which is equal to the total amount you have contributed at the start of policy plus the growth of revisionary and terminal bonus. The policy will come to an end. Now, if there are two insured, so one dies, the second policy, there is no death benefit paid, the second insured continues the policy and can add the another insured in the policy. Death benefit will be paid only in the case when the one person dies and the second person dies later, the policy will come to an end. But if you add another insured in the policy, then both have to die for the policy to come as a death benefit. Now, so as I said, it is explained here. After one of the insured passes away, will the policy automatically change from joint life insured into single life policy? No. And the death benefit will be payable until death of the last surviving insured. Can client replace the insured who passed away to let the wealth accumulate go further? Yes, it is possible with change of insured option. You can add another person or you can transfer the policy to another person, which is basically your family member. You cannot pass on it to the third party. Now, let me give you an example here. Mr. A is a professional. He is doing estate planning. He purchases this plan with his hard-earned savings to go further. He buys a single premium policy for $1 million. Now, at 0 years, he purchased the policy. Year 2, what he does, he changed the cover option to switch the policy into a joint life with his son and adds his son as a second insured. At year 10, Mr. A changes the policy owner to Mr. B. So he transfers the ownership of the policy to his son. The total surrender value at that time is 1.434 million. At year 40, Mr. A's twilight year, Mr. B executes the change of insured option to change the insured from Mr. A to his son, Mr. C. So what he does, he exits his father and brings his son in the policy. So now he himself and his son is the policy owner. So the total surrender value at that time is $9 million. Now, when he's changing this insured option, this gives him a flexibility to run this policy for maximum 120 years. Because when you're changing the option of insured, you are bringing the younger one in the policy. So the policy can run maximum up to 120 years. So if you see at the end of 120 years of the policy year, which is the age 90 of the C, the maturity benefit reaches to this huge amount, which is actually 320,967% of the initial premium paid. So this is the power of this plan. There's a huge growth in long term when you keep on passing the insured. And the other benefit is, if you don't want to pass on, you can surrender the policy. You can use the benefit, or different way. You are taking the partial benefit, you are using it for yourself, and the balance you are passing on to the next generation, which is very difficult to do in illiquid assets. As I said at the start, You can't sell part of your assets and enjoy the rest, or you can't sell part of your business, because somewhere there's an emotional attachment also with the properties which you have inherited, or the business which you have inherited, or even if you have built. You don't want to sell part of that, but here it's a liquid cash. You can sell it, you can use it for yourself, and the balance you can transfer to the next generation. Now, let me give you a live example of this illustration. So here $1 million is paid by a client. If you see, there's a guaranteed cash value of 880,000, which is 88%, which is up to 90th year. 20th year onwards, it becomes $1 million. Now, there's a terminal bonus which starts from year 3 and revisionary bonus which starts from year 10. Actually year 8, because this illustration is calculated on number of years, so it starts from year 8. So the value is 63,591 for revisionary bonus, and terminal bonus is 491,000. So if you see, $1 million in 10 years time becomes $1.434 million. In 20 years time, the value of 1 million is $2.6 million. In 30 years time, the value is $4.7 million. Now 30 years, this is calculated on basis of 45-year-old person. Now 45-year-old person in 30 years will be 75. He says, I have a cash value of $4.7 million. I am withdrawing $2 million for myself, and balance I'm transferring it to my next generation. I'm changing the ownership to my son. He can further keep on growing it. The value keeps on growing. You can withdraw money partially, balance you can transfer, or maybe sometimes it happens with the family, they don't want to pass on to wealth to their next generation, because the next generation is not living with them or not part of the business. But legally what happens, your business, your illiquid assets, which is property and all, automatically gets transferred in case you are not there. Or other way is that you sell it off, you liquidate everything, and you can use it for yourself, which again is not easy, it's challenging. But this one, you have liquid asset, here you say it's $4.7 million, I don't want to transfer, I want to cancel it, I want to use the money for myself, you can use it. Many of the clients has done in a way, they have taken a policy, when they reaches at age 70, they start withdrawing equal amount every year for next 10 years till the time they reach age 80. So they have fulfilled they have secured their retirement by getting a decent amount every year, and then balance they transfer to the next generation. They keep on growing it further. At their 65, 70, they start withdrawing a equal amount every year to enjoy for their next 15, 20 years till the time they feel that, okay, my retirement is secured, balance is transferred to next generation. So by this way, you are using the liquid asset in this plan to secure your current, secure your future, and then further transfer to next generations. Now, another interesting part, you might come here and say, okay, it's difficult for me to invest $1 million because I don't have liquidity today. Though, yes, I have assets, but all are invested. I don't have $1 million. So there is another interesting part here is financing. So what we can arrange here is, there's a guaranteed cash value of 88% here. So from day one, 88% can be financed. So you have to just contribute 12% upfront. So in this case, you just pay $120,000 upfront, and balance 880 is financed, and full $1 million will be invested for you. This growth will remain the same like this. The only thing is that you don't have to contribute 1 million together. This can happen through premium financing. So it can be financed by banks, it can be financed by private financial institutions, where 88% guaranteed cash value is financed. Now, simple way is, there are two different processes run. We get the approval from Sun Life, and we get the approval from bank or the financial institution who is financing the policy. Both is approved. The money is paid from the financial institution to the Sun Life, and the difference is paid by the client to the Sun Life. The policy gets issued. Now, looking at the financing side, yes, if you look at the today's scenario of interest rates, yes, it is slightly high because the Fed rates are increasing and all. So currently, including the spread rate offered by the financer, the current interest rate is around 5%. So I'm just giving an example of 5%. But if you look at in longer term, if you look at the past history of LIBOR, nowadays it has shifted to SOFR. Most of the lending institutions has shifted from LIBOR to SOFR. But even if you look at the past history,
Some years might be high, some years might be low. So we are expecting an overall interest rate should be somewhere around 3.5% over 20 years. Now, best part with the financing side is that you even don't need to refund the capital. You will just pay interest, that too for 20 years. And on the 20th year, your policy itself has enough value which can settle off your loan. So after 20 years, your policy becomes totally free, debt free, and it will keep on growing. So if you look here from the financing angle, if I say, so in 10 years time, the value of your policy, the return, internal rate of return is around 5.55%. So on $1 million, you got a growth of $554,000. Now, looking at the interest side, because it is high, it is negative because you have already paid $560,000, which is your initial contribution of 120 plus the interest of 440 which you have paid, which I'm calculating at 5%. But in longer run, it will going to come down. So it's minus 0.93%. On 20th year, your loan of 880 which you have taken got settled from your policy. Still you have a growth of $1.675 million, which is 8.38% overall return. And after settling off everything, you have paid 1 million in 20 years time as an interest and upfront. Your internal rate of return is 3.37%. Now your policy is debt free after 20 years. It will keep on growing. So if you see in 30 years time, the net return is 7.3%. In 40 years time, the net return is 13%. In 50 years time, the net return is 22% on dollar terms, which is a very decent return. Now with the loan part is that with financing, you get an edge of investing higher amount. But if you have to pay money from your own pocket, definitely it becomes difficult to pay maybe 1 million, 2 million, 5 million or 10 million upfront because you have that, but that is invested. You don't want to liquidate that. With this, you just pay 12% upfront and then you can invest the higher amount. And with financing, you can even settle off your financing prior to 20 years. If you have money, there is no prepayment penalty, nothing. You can settle off your loan. So basically, if you are taking $1 million, currently if you check, you are paying $44,000 as an interest every year instead of paying $1 million upfront. Interest rate in longer term will definitely going to come down, but we are calculating it at 5%, which is current interest rate. Now, investment philosophy, you might have seen it is growing too much, how they are generating that kind of a return and all. So there's an investment philosophy of 70% of equity exposure in asset allocation. So with this plan, fixed income assets, they can diversify between 30 to 90% and non-fixed income assets 10 to 70%. So this is the diversification for this particular plan. Now, if you see fixed income assets, where they invest, there is a sovereign bonds, corporate loans, non-fixed income assets, public equities and private equities and so on. So basically Sun Life, their in-house investment strategy, and this strategy works on their existing other plans, which are generating very good return for them. So which I will share in the further slide, how they are generating, giving returns on the other plans. Now, this is what is there, which is called fulfillment ratio. Why I can't give you the history of Venus plan? Because it is just a 1-year-old plan right now. So if you see, the same investment strategy is applied on other plans also. So this is the track record from 2010, where it is mentioned 81% or 105% or 100% or 97%. This is basically what returns is shown in the quotation. Are they fulfilling the same or not? So if it is shown X value and it is 105%, that means they have paid 105% of that X value. So it's a very decent fulfillment ratio from their side, which they are fulfilling year on year. On some plans, they have even given 149% of what they have committed, what they have shown. So this plan is an excellent plan if you are looking to create a liquid legacy for yourself, which you can enjoy. Then you can pass on to the next generation, they can enjoy, they can pass on to the third generation, they can enjoy. And with premium financing, this will give you an edge with higher investment by contributing only 12% upfront and then interest year on year. Now, if you have any queries for this plan, please email to us, reach out to us. We will definitely give you all the details. If you want specific quotation, please feel free to email to us. We will come up with the quotation. We will explain you the plan in detail. The minimum amount to start with this plan is $150,000, and for maximum there is no limit. But if you are looking for financing side of this, we would appreciate a minimum $500,000 worth of investment so that financing can be arranged with private finance. And the best part is there is no collateral required. There is no portfolio required to be kept with the private financer for arranging financing for this policy. So thank you very much, and I hope you like the plan. Please reach out to us. Have a good day. Thank you.
Well, I hope you found that presentation as interesting as I did. It was extremely enlightening in terms of the different benefits that this product can offer, not just now, but in the future. If you would like any more information, do not hesitate to contact your financial advisor, or if you are new to VFS, please contact us at www.info@vfsint.com. Thank you very much, and wishing you a very Merry Christmas and a Happy New Year. Thank you.